Welcome to tax credits many retirees miss in Canada. Most retirees focus on one thing: income. How much CPP they get, how much OAS they receive, how much they withdraw from their RRIF. But the real difference between retirees isn't always income. The real secret is often tax credits. Two people can have the same retirement income and still pay very different amounts of tax because many retirees miss credits they qualify for. Let's walk through some of the most important ones. First, let's look at the pension income tax credit. This is one of the most valuable credits retirees often overlook. If you receive eligible pension income, the federal government allows you to claim a pension income tax credit on up to $2,000 of that income. That means the first portion of your pension income gets special tax treatment. But here's the catch: not all retirement income qualifies the same way. For example, at age 65 and older, income from a RRIF usually qualifies. A workplace pension qualifies. But CPP and OAS do not qualify for this credit. This is why some retirees start converting part of their RRSP into a small RRIF at age 65. Even a small withdrawal can unlock the pension income tax credit. It's a simple planning move many people miss. Next, we have pension income splitting. If you're married or common law, this can be extremely powerful. Canada allows you to split up to 50% of eligible pension income with your spouse. This doesn't mean actually transferring money. It's simply done on your tax return. But the effect can be huge. For example, imagine one spouse has $40,000 in pension income and the other has only $10,000. Without splitting, one spouse may be pushed into a higher tax bracket. With splitting, both spouses might report $25,000 each, same household income, but often lower total tax. Now let's consider the age amount credit. Once you turn 65, another credit becomes available: the age amount. This credit reduces taxes for lower and middle income seniors. However, it gradually reduces as income rises, so retirees with moderate income may still qualify for part of it. This is another reason tax planning matters. Small changes in withdrawals can affect eligibility. Finally, there is the medical expense tax credit. Medical costs increase for many retirees, but those expenses can also reduce taxes. Eligible medical expenses may include things like prescription medications, dental work, hearing aids, mobility devices. Many retirees forget to track these costs during the year, but they can create meaningful tax savings at filing time. The basic personal amount. Another credit that quietly reduces taxes for retirees is the basic personal amount. Every Canadian receives this credit. It allows you to earn a certain amount of income before federal tax even begins to apply. For many retirees with modest income, this credit already shields a large portion of their retirement income. For example, if someone receives CPP, OAS, and small withdrawals from their RRIF totaling around $20,000 to $25,000 per year, much of that income may already fall within the tax-free range created by the basic personal amount and other credits. This is why some retirees are surprised when they owe far less tax than they expected. The spousal amount credit. For couples, another important credit is the spousal amount credit. If one spouse has very little income, the higher income spouse may be able to claim this credit. Let's look at an example. Imagine one retiree receives $45,000 per year from a workplace pension and RRIF withdrawals. Their spouse receives only $12,000 from CPP and small savings income. Because the second spouse has relatively low income, the higher income spouse may be able to claim a spousal amount credit. That credit can reduce the overall tax paid by the household. It's a simple rule, but many retirees don't realize it still applies after they stop working. The disability tax credit. Another credit that many retirees miss is the disability tax credit. This credit is designed for people with serious physical or cognitive impairments that significantly affect daily living. Conditions involving mobility, vision, or chronic illness may qualify. If approved, the disability tax credit can reduce taxes owed each year, and if the person does not need the full credit themselves, part of it may sometimes be transferred to a spouse. Because the application process requires medical documentation, many eligible retirees simply never apply, but for those who qualify, the tax savings can be substantial. The home accessibility tax credit. Many retirees eventually modify their homes to make them safer. Things like installing walk-in showers, stair lifts, wheelchair ramps, or safety railings. What many people don't realize is that Canada offers a home accessibility tax credit. Eligible renovations designed to improve safety or mobility can qualify for a tax credit. That means upgrades that make a home easier to live in can also reduce taxes. For retirees planning to age in place, this credit can be very valuable. Timing medical expenses. Medical expenses can also be planned more strategically than many retirees realize. Canada allows medical expenses to be claimed within a 12-month period ending in the tax year. This means expenses don't have to be limited strictly to the calendar year. In some situations, grouping larger medical costs into the same 12-month period can increase the value of the credit. For retirees facing dental work, surgery, or other large costs, timing those expenses carefully can increase the tax benefit. All of these credits show something important. Retirement taxes are not just about income. They're about how that income interacts with tax credits, deductions, and benefits. Two retirees with the same income can end up paying very different amounts of tax simply because one understood the credits available to them and the other didn't. Because in retirement, what matters most isn't just what you receive, it's what you keep after tax.